So the pendulum is swinging. As we can see, renting is now looking better than buying a home in many U.S. cities. Stay tuned. You're going to talk about the top 10 cities that are better to rent than to buy. So for many of you, renting versus buying is a key metric for investing, especially if you're a landlord or you're investing in something that you want people to rent. In this particular report by CoStar, which is fresh off the presses, goes on to say that Spokane, Washington currently is the top city to rent versus buy in the entire country. But as you guys know, things are moving and this can change in just a couple months. The first thing to look at is there's three main factors that you want to look at, and there's not only three, but these are three main ones that you want to look at before you're buying in any market. The first one is, of course, where are rents going? Are they going up or are they going down? The second one, of course, are home prices. Are the home prices going up? Or are they going down? And I know there's a lot of information behind all of this, but I'm going to leave this up to you guys to figure this out, because this is a big reason as to why these numbers in cities can change from month to month. The last one, which is creating all the affordability issues, and the reason why renting is now in favor in many, many markets is because of the interest rate hikes that we're starting to see from the Federal Reserve. Of course, we've had 5 increases since March as they try to battle inflation, but as these interest rates continue to go up, then affordability of single-family homes also continues to go up, which makes renting better. The opposite is also true, because as homes become more affordable and mortgage payments come down a little bit in price, then of course it possibly is better to buy than to rent. In either case, this is great information for you to know if you're a homeowner or whether you're an investor looking for renters. So now let's take a look at the methodology and the rationale that CoStar did. And by the way, this is really not that difficult to figure out. This is simply dividing the area's average home price, which you guys can know can average all over the place depending on where you are in the country, by the annualized rent in that same market. That's all this is. But CoStar did it in 100 markets, and that's why this is actually fascinating to see right now. The reason that this is so prevalent right now is because home prices have gone up historically pretty rapidly, so has rent, but so has interest rates. So the mortgage payments are moving much quicker than rent payments. So what does that mean to the average real estate investor? What that means is as home prices go up and mortgage payments go up, then the gap between the rent and the mortgage gets higher. It's actually better if you're a landlord or if you own investment real estate in that area, because it's forcing more people into rentals. As it says here, as the Federal Reserve raises target lending rate, as it did just recently, that it moves and boosts the mortgage costs for the area, thus pushing more people down into the rental housing market. One thing to watch is as people move into rentals, it actually slows down the demand for home ownership, which also continues to have home ownership prices drop even more, putting things back into balance. So if you own rental housing or you're a landlord in any of these 10 cities, this is actually good news for you. If you're a renter, this actually means that it's harder for you to buy a home in these particular markets, but that doesn't mean you can't move to another market and buy there if you can. But at the moment, this is just math and logic and based on what's happening in this area at this time. Of course, this is a very narrow way of just taking a look at what's going on with renters and the cost of owning a home in those particular markets. It doesn't take into account any of the tax benefits or anything like that, or building equity in a home or anything like that. This is just math, taking a look at the mortgage cost versus the renter cost, that's all. But it is a leading indicator if you're buying in any of these markets, like we're buying in Austin, and as you can see, what this means is that rent is significantly lower than the cost to own a home in Austin. Now, there's a lot of discussion around rent growth, and people, of course, are upset about rent increases, and that's been in the news as of lately. But what's not talked a lot about is the cost of owning a home and the affordability. As you guys know, housing affordability has hit a 33-year low. And that, of course, is 2 factors. One is the price of a home and the price of the cost to buy a home via interest rates. This chart is the home ownership rate in the United States, which is somewhere between 65 and 66%. And as you guys know, I do believe that that's actually going to be going down over the next period of time as a result of this issue right here. So this particular chart is Black Knight. As you guys know, I use Black Knight all the time. It's a great website, but all they've done is they've tracked the monthly P&I payment to purchase the average price home. Now this is nationally, so it's not going to work in your particular market, but all you got to do is look and calculate what it is in your market as it relates to the rent cost or the annualized rent in that market, and you'll come to the same conclusion. What I really want to draw your attention to is this right here, guys. Take a look at what has happened as a result of these rising home prices and rising interest rates as it relates to the cost of buying a home. This is what I'm watching right here, because as this number continues to go up, as the Fed continues to raise rates to tamper inflation, then of course this could spike up to 2,200, 2,300, 2,400, even higher. And all this is going to do is reduce the home ownership rate and increase the renter households. And this is all happening right now as a result of not just the rising house prices, but the rising Fed funds rate that we think is going to continue to happen through the 2 more meetings that they're going to have this year and even into 2023. Now, it's possible to see this soften a little bit as we are already starting to see some of the single-family markets start to stabilize and even go backwards negatively. But it'll be interesting to see and to watch to see whether or not those decreases in home prices are going to compensate from a rent standpoint as interest rates continue to go up. So we'll have to watch to see what happens, because you might get lower house prices, but if you're getting higher interest rates, there might not be that much difference here.